Welcome to TheoTRADE. This is Don Kaufman. It's January 3rd, 2025. There's just about 30 minutes to go to the cash close here on the second trading day, 2025. Markets, well, taken off to the upside, but, well, for now, enjoy the bounce back and we'll possibly get ready for another smack. I am going to explain that and much more here, of course, on this TheoTRADE weekend update. Let's get right to business. S&Ps are up some 71 handles right now, but well, I'm not even going to spend any time, dancing around this. Just cut to the chase. There's no size behind today's trade, and it's unusual because even throughout, and I'll give you an example here, even like New Year's Eve, saw considerable size, more so than we're seeing on today's bounce. So is that really a huge tell? Does that mean the markets are going to spin back around? Not necessarily, but I am going to say right off the bat here, there's not a lot of conviction on the buy side here. This is a bounce. Take it for what it's worth. This is a bounce. In fact, even with 30 minutes to go to the cash close, this market may actually sell off while I'm actually doing here the weekend update. And again, I don't mind putting a title, enjoy the bounce while it lasts, because it very well may not continue. So the first thing to discuss here is that correlation continues to wreak two-sided havoc upon this marketplace. And it's something I've been talking about extensively. We had not seen for a considerable period of time, and it kicked off. The catalyst for the correlation was right here. Okay, here being the Fed. Okay, the Fed comes out December 18th. All of a sudden, snap! We're back into high correlation. Now, high correlation, okay, often brings with it two-sided trade. And that is exactly what we are seeing. I'm talking about high correlation. Let's be really, really specific. Most days, okay, throughout the course of this week, and it is a weird week because you're open Monday, open Tuesday, like maybe some light volume. Obviously Wednesday during Happy New Year, we're closed. We open up Thursday. Thursday's absolutely rocking for the first trading day of the year. And here we are on Friday and things start to die out. But throughout the course of this week, there's been really high degrees of correlation. And it was even true during Christmas week where, and again, I've been talking about this so extensively, we see like 90 products trading to the upside, or the other day we actually opened literally 100 products trading to the downside. You got to love that stuff. High correlation. High correlation, we're not seeing heavy sector rotations right now. And even though today there were pockets of strength, and there's no question, like, Tesla, okay, what gives? I thought they were going to fall out of bed, and Tesla comes ripping back over here. Nvidia, nice rip back inside of Nvidia, but it's not like this classic rotation that we've seen that's been like, okay, let's everybody sell financials and buy tech, and okay, let's everybody sell energy and buy this. We're not seeing that kind of that rotation that we've been seeing, over many, many months. We are seeing right now much heavier degrees of correlation. As long as that is there, we're going to see some fairly wild, unruly, two-sided trade. And to give you an idea of what two-sided trade kind of amounts to, for those, again, that don't necessarily speak trader geek, look at the cash open this morning. Do you have any feel for this? Okay. And then people are like, what do you mean? Oh, it went up and went down. It's actually not what I'm talking about. You have 10-point moves happening inside of 1 minute. Okay. And it's happening in, okay, a multitude of moments in trade over here. This is what I'm talking about with, this reeking of this two-sided trade. By the way, it's to the downside and the upside. That's not supposed to be necessarily a bearish connotation. It's correlation. All of a sudden, it's like shock and awe. What's actually going on is significant size trades are actually hitting the S&P futures markets, and it's just resonating through the entire marketplace. And that's a statistical arbitrage. So the trade happens here, okay, and reverberates through the entire S&P 100. So that's what I mean by correlation continues to wreak two-sided havoc. Some really, really substantial trades were coming out of the woodwork and rocking that marketplace. And that's been going on for the last couple of trading sessions. I mean, you saw it obviously in yesterday's trading session as well. This is Thursday's trading session. Look at this. Okay, that should scare anybody. I mean, you have the S&Ps that are trading basically 59.60. And what? A few minutes later, these things are actually trading 58.80. Right? This is a unruly move in the marketplace. And that's why I'm telling you, like, stay in store for, again, this is a bounce back. It's a light volume, okay, bounce, but I would get prepared for another round of sell side activity. Even if we, I'll tell you something interesting about this. If we do follow through to the upside into early next week, there's going to be some great shortable opportunities, but I'm just not sure the market's going to hold up that long. As I said to you guys moments ago, I'm not even sure we're necessarily going to, continue to hold these gains. I mean, we're going to be up today. There's no question about that. But you can even have a scary few moments coming into the close today. There's just no volume, though, right now. All right, let's move on. So you're starting off with a what I would term a less than happy new year. The S&Ps have actually been, and again, this is the SPX specifically. The SPX, okay, where I'm highlighting right now on your screen, that's the starting place for the week. This is the lower edge of the expected move. The S&Ps out of the gate, it's a 4-day trading week, are basically holding right into and on the lower edge of the expected move. So we are going to end the week down. And so many people, like, they get caught up in the whole, like, it's the January effect. It's how we open the year defines what the year is going to look like. Well, if that's true, which it's not, because there's been a ton of stuff to obviously offset that. But if that's true, this is not looking like a good start to the year. There's no question about it. In fact, so the S&Ps are going to finish the week lower. Taking a look at the QQQ, if you look at the QQQ, bring up auto expected moves, the Qs will also finish lower. They've actually smashed outside their expected move yesterday. Nice little rally today, though, but that rally is brought to you by, as I was saying a moment ago, NVIDIA and Tesla. Now, there's your marketplace effectively today. So a bit of a less than happy new year. I would also like to bring up the Russell. Okay, look at auto expected moves here. The Russell is actually outperforming, which is interesting because it was the underperformer really in recent trade. So, all right, let's push past that. So correlation wreaks havoc. You got two-sided trade ahead of you. Okay, less than happy new year. Although I don't buy into that at all. Like, again, the first week, okay, or the first couple of days of trade does not set a tone, okay, for the remainder of the year. So I want to dispel that rumor like right now. One thing I do want to keep you in store for, traders, okay, and investors alike need to shift gears. Like, you got to learn to shift gears. Volatility is definitely here. And I've been saying that a lot inside of the TheoTRADE chat room. And I want to reiterate that very point, make sure everybody, okay, understands what I mean by that. All right. Timing markets and going out and thinking that we're just going to be able to buy the dip, okay, appears to be over at this point. And it died out basically on December 18th. Okay, not because we're necessarily lower, but because how violent some of the two-sided trade happens to be. At this point in time, and again, we're going to talk about specific levels. At this point in time, okay, we're shorting rallies. We're actually shorting rallies. And this, okay, I actually hope that we're up again on Monday to create a little bit more of a, shortable opportunity in a couple of major ETF products and or equities out there. So shift gears. Use things like vertical spreads, in-out spreads, okay? Define your risk on an intraday basis. You better pick your entry points really, really carefully because there are just some angry products in this marketplace. But I can't stress that enough. What I'm really getting at, and I'll just clarify this, the day of the bell going off, okay, and you showing up like Pavlov's dog for the treat when the bell goes off and just buy the marketplace, and every time we dip, we buy it, it's over. And if you don't see that right now, okay, you're going to get systematically dismantled by this marketplace. That is what a higher correlation, okay, higher like impact marketplace is going to bring, okay? So I want everybody to kind of tune into that. And this is where people start talking about, volatility. We're going to come into volatility in a moment. Okay, because the people will, like, as I'm saying this, like, well, the market's rallying, the VIX is only at 16. Okay, so how can you say that there's a volatile marketplace, the VIX is at 16? We'll come to that in just a moment. Before I get there, I want to show you, okay, some levels in the S&P 500 that I think are critically important. Okay, we have been dancing and bouncing, okay, in these big reactionary lows here in the S&P futures. Now, again, I want to be very, very specific about our levels here because we may actually be facing some critical levels. In the S&Ps, okay, there's big reactionary lows, obviously on the 18th, okay, 2 days after that, yesterday, okay, and even this morning. And that level is somewhere at this low. It's somewhere right around in the S&Ps, okay, 59.11. 59.11 seems to hold considerable weight. You break below that, okay, from my perspective, right, and given the fact that we've seen that level before, I think you have a pretty serious chance of some wild sell-side activity at that point. There's another way actually to bring this up. In fact, I'm going to do what's called contract adjust this. Okay, there's another way to bring this up. Instead of looking at a daily, we're actually going to look at a 30-day 1 hour in here, and then we're going to come in here. We're going to hit futures, and we're going to go adjust for contract changes, hit apply, hit OK. This is makes what we call a continuous chart. You get a better view of some of these levels. Okay, the level I was looking at specifically is right in and around where my mouse is. Okay, which is here. I'll even highlight this for you. Somewhere right in this neighborhood here of the 59.11. Okay, and you can see it's been big reactionary lows. We did punch through it momentarily. Okay, but I would pay very, very careful attention to that level. I'm actually going to now bring it out 180-day 4 hour. Okay, and I'm going to put the cursor right on that again, 59.11. So if you will, 59.11, somewhere right in this neighborhood here, and you can see that level holding tremendous weight from both tops. Okay, and a few key reactionary bottoms in here. We'll see what happens if and when we do actually cross through it at some point in the next week or so, because I think you'll see some fireworks in this marketplace. All right, next thing on the docket over here. So that S&P 500 level, okay, is 59.11 in there. And again, that is to the S&P futures, not the SPX. Next thing, volatility check. Sure, people look at the VIX, okay? The VIX, again, it's an equation based on the SPX. I'm much more in tune with what the volatility futures are doing. And there's something really interesting in the volatility futures, and I think you should pay attention to it right now, okay? And again, this nice 4-day trading week, the thing is, like, high correlation in the marketplace, people want to look at individual stocks, okay? Why waste your time? I'm not joking with that. Why waste your time? Oh, I want to look at this and I want to look at that, okay? Look, we're going to look at a few individual stocks here in a moment. But you got to be looking at the broader marketplace. You got to be starting to read volatility. Because as I said, traders need to shift gears. Volatility is here. So you should be looking at the right volatility products. One of the volatility products I'm looking at right now, see, these Jan volatility futures, and this volatility future, okay, and I'm actually going to kind of script this on the screen with you, just so, again, I want to make sure everybody understands. This is the / okay, VX, vol futures. The Jan has like 19 days left. Okay, and that's, I don't want to say it's toast, okay, it's still the active contract, but to me, it means a lot less right now, given the fact it's a very short duration. The thing that's a little bit alarming here is if you look at like February volatility futures, okay, March volatility futures, okay, and April volatility futures, all right, Feb is now sitting at what, 17, okay, 56, March, okay, March is up to what, apologize, 1795, and then all the way out to April is 1817. The reason I'm writing these out, because I know it's a little hard to see on the screen, but the reason I'm actually writing these out, the distance between Feb to March and March to April is nominal. We're actually a lot closer, okay? We're in what we term contango right now, but we're actually a lot closer to a backwardation in volatility futures than I believe we normally would be with a marketplace like, oh, the S&Ps are up some 70 points. okay? One of the reasons I say this is a bounce, because the volatility is displaying exactly that. Like the distance between Feb and March is not really widening out in here, okay? This is a very, very shallow, if you will, contango. We're very close to, like, we get a little sell-off over here and you're going to be right in backwardation. And what's weird about that is that's kind of when all hell is breaking loose in a marketplace, okay? So from my point of view, when you're looking at volatility is like, well, we may have rallied and we're not doing half bad. Like, let's not, everybody, let's not freak out. We're only a few days from the all-time high, literally a few days removed from the all-time high, 200 S&P handles from the all-time high. And yet there's some cause for concern because volatility doesn't look that way. Volatility actually looks like crap's getting serious right now, but the S&Ps haven't felt the impact yet. That is exactly what I want to bring to you. That's why I give you a little bit of a volatility check. Okay, next couple of things. Apple. I don't care that Apple's down, but I did tell everybody last weekend's update, the weekend before that, if there's a product to short, if you think this market is coming down, what did I say last weekend? I said, you short Apple. Okay, Apple's down. By the way, I only talk about stuff I have positions in. Of course, I have positions in here, and I am short Apple. All right, and Apple has come off quite nicely. Now, let me give you a couple of other aspects that really resonate with me. I'm in a short position in Boeing. Why am I bringing up Boeing? Okay, because it's down in a day that the S&Ps are up big. Okay, I'm already in a short position over here. This is another one that after a spectacular run looks like it's going to continue to come off hard and fast. So here's the position right there. It's an in-out spread. It's right on the dance floor, making some decent money. Okay, next in the docket, let's talk about gold. Okay, why? All right, gold taking a little bit of a hit today. I am pulling up specifically GLD. Okay, GLD. Now, you can look at the gold futures, and I'm fine with that, but I'm trying to make this much more appropriate for retail trade. And I actually put on a bullish spread inside of gold today. Am I wildly bullish in gold? Nope. But I will tell you one thing. Look at the stellar move up in the US dollar. I mean, you've seen some wild things before, but that's right up there. I am not sitting here like, oh, I'm so bullish in gold. Like, I'm not sitting like the world's going to come to an end. I'm buying gold. Like, that's not what I'm about. What I'm about is I think there's got to be a pullback in the dollar. When there's a pullback in the dollar, it's going to force gold a little higher. So I took a bullish position inside of gold. Okay. Yet another position I want to talk about. So again, I love going through some of the positions that I referenced, like Apple. I was like, get short. If you want to be short the markets, that's the product to be short. That's working. Gold's newer position. Okay, I'm bullish in there, but I'm more bearish in dollar, just in the near term. By the way, I'm not outright bearish in dollar. I just think dollar's got to pull back at some point because it's getting out of control. Okay, and as the dollar actually pulls back, it's going to force gold a little higher. Then bonds. Okay, bonds. Now this one I do have an opinion on. Bonds, they still have room to go to the downside, but make no two ways about this. I am selling puts. I am selling puts in bonds. I want to get put bonds. Bring it. Sell puts and bonds, okay? And I'm doing it because I think the bonds, they might not necessarily be at the bottom, okay? But they're fairly close to it. And what I'm looking for in here is this reaction where the bonds could sell off and then start to rip a little higher. And I'm going to tell you right now, I want to be in bonds, long bonds, and I want to be long bonds in a big way. And I know a lot of traders that have been long bonds, and I know a lot of traders that have been getting killed in long bond positions, just like annihilated in there. Yeah, well, now I'm jumping in, okay? I like to be a little bit late to that party, okay? Make no two ways about it. I think bonds can still break down. I think there's some bond vigilante-isms going on, which basically implies the bonds are going to go a little bit lower, okay? But this could actually be one of the greatest opportunities that we've seen in bonds literally in years. Like if you can pull up even like a 15-year chart, look how substantial. That's a 15-year chart, okay? Pull up the max chart available and you're like, holy crap. I mean, you're selling out of the money puts in here. Let's get crazy and say you sell like a 105 put. You realize 105, where that is in the chart. You got to come all the way back to time frames of like, pre-financial crisis to see that. So again, I think it's pretty opportunistic out there in the bond market right now. Definitely selling some puts to get long the bonds. All right. Last but definitely not least, I always talk about the SPX and the expected move. The expected move for this week of trade that we just passed through, and again, the week of trade that we just passed through is 4 trading sessions. The expected move, okay, was $83, pretty much on the button. It was 83.01. So what this basically implies, $83 move. You're looking for an $83 move higher, $83 move lower. Obviously, we hit the $80 move right off the bat. What do you call $83? I call that Monday and Tuesday, okay? Thursday. Here we are. Like, the one thing that I guess doesn't really like jive in my brain right now, okay, is that you have this $83 expected move. I mean, what the market's almost moved that today. Like, why is the expected move so low? Like, we're rocking with volatility. And then you think about that, and you step back from the screen. Like, again, the two just don't mesh in my head right now. Okay. Then I step back from the screen. I go, oh no, this is an opportunity. Like, people are going to get run over. You do not want to sell short dated options right now. You're going to get run the hell over. We're getting moves, that are huge on an intraday basis. Did you not see the wild movement yesterday? Okay. This is during trading hours. This is not even like overnight trade. The S&P is traded 59.35 all the way to what? 58.29. This is over 100 handle move from high to low. And yet the expected move for the whole week is what? $83. Okay. Now next week, this is a 4-day trading week. And the week before that was a 4-day trading week. Well, guess what? Next week is also a 4-day trading week. Now, this is going to baffle some people. Okay. But the markets will be closed on Thursday. And of course, that is because of the funeral of Jimmy Carter. But there is an expiration on the Thursday. Don't trade it. Don't do anything. They already knocked the volatility down. Basically, it goes off the previous day's close, right? So the expected move on Thursday is basically the same as the expected move on Wednesday. So you don't have to think about it. Don't trade it. Don't think about it. There's no free money in there, okay? But what really kind of grabs me is when you go out to next Friday, the expected move is $85. But it's a 4-day trading week. Again, where you're going to go into a 4-day trading week, it's only $85. And again, that just doesn't sit well with me. Why? Because you're moving that like almost now. I mean, you have a 70, 80 handle move today, and you're telling me that all of next week we're going to sit in an $85 range, higher or lower, okay? That's why it doesn't mesh with me. So, well, for now, as I was saying, enjoy the bounce back. Okay, take what the defense gives you. Use it as an opportunity. But get ready for this marketplace, once again, to get wild, because all the signs are on your screen of some volatility, some real volatility starting to emerge. Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.